our bureau over in Hong Kong. It's good to see you again, Dariusz. Why don't we start with absolutely welcome. Why don't we start with those jobs numbers due out of the U.S. tonight? The consensus is for 340,000 jobs lost in the month of November. What are you expecting, and is it going to get worse from this point?
I think that we are going to see a slightly less negative number. My call is 300,000, and I'm basing it on the comparison of how various measures are behaving now and how they did the last time we were facing similar destruction in the labor market, which is in the third quarter and fourth quarter of 2001. Many indicators for the month of November have already been released, such as ADP, jobless claims, Challenger job cuts, ISM reports. Some of them are pointing to fairly high job losses, around 350, but some to only about 250, so I'm calling for 300. But 300 is still a very big number, and I think that the losses will get worse as we move into the end of the year and at the beginning of next year. So definitely negative contribution to U.S. growth from the labor market and from the consumer will continue.
Dariusz, it's Rebecca in London here. It does look like those jobs figures are going to get worse, doesn't it? If the announcements we've had from some of these big companies in the past few days are anything to go by. I mean, how's that going to feed now into the decisions the Fed find themselves taking in the next few months? Not much room for manoeuvre, is there? But is the Fed going to come under increasing pressure to take more and more action as this picture just deteriorates?
I think that the Fed has done almost as much as it can do in terms of lowering the short-term interest rates. I think they will go to 0.25 percentage point by January. It doesn't really matter if the rate goes to literally zero or not, but it will be very interesting to see how far they will go in terms of bringing down longer-term rates, in particular on mortgages, how much they will purchase. Will they purchase treasuries? They definitely can do more in terms of the longer tenors on the yield curve, and not only on the sovereign debt but also on the riskier debt. They will definitely come under pressure to do so, especially that the democratic government and democratically controlled Congress have the historical preference to see more aggressive action on the part of policymakers to stave off the recession.
Dariusz, all of these policy initiatives, I mean, it's incredible to stand back and watch what's been happening over the past several months, unprecedented in some cases. What are the risks involved with this? I mean, everyone's saying, okay, we hope it's going to work, we're hoping it'll kick in at this point, but are there any risks involved? Could this go wrong somehow?
The negative consequences of the huge creation of money supply and potentially of fiscal deficits will not be felt in the near to medium term. And the short-term outlook is what's driving policymakers right now. When the fiscal stimulus and monetary stimulus allow the economy to recover, going forward, definitely there will be a risk of another bubble. And I'm not sure yet in which asset class or classes it will show up, but definitely imbalances are being created right now. However, it's too early to take positions in the market to benefit from that or to escape such consequences, because the economic cycle of recession and then recovery has first to play out. And this will take until the middle of next year, at least.
Okay, well, thank you so much for your insight today, Dariusz. Always good to have you on the show. That was Dariusz Kowalczyk, the Chief